Welcome to Harrison Clark Rickaby's. Today we'll be talking about the transitioning away from liable, due to take place back end of next year. Just a couple of housekeeping points. Obviously, we're talking and broadcasting remotely, so my apologies now in advance of any technical issues. Hopefully there won't be any. Apologies there. The format's simple in that it's broken into two parts. I'm joined, thankfully, by two experts in their field. I have Hanif Verji of Vividum Limited. Hanif is a financial markets expert. Hanif will be talking about the liable replacements and the fallback provisions. And then following Hanif, we have Harry. Harry's Harrison Clark Rickaby's partner, heads up our banking finance department. And Harry will be talking about the timelines, looking at assessing the exposure to businesses and potentially any relevant documentation. My name's Adam Finch. I'm also a partner at HCR, specialising in financial services disputes, and I will be chairing the event today. I'm delighted to say we already had a number of questions come in. Please send any more using the Q&A function at the bottom of your screen, and we'll do our best to answer as many of those at the end of the sessions from Hanif and Harry. Otherwise, with an eye to the timing, I'd like to introduce Hanif to start his presentation on liable replacements. Over to Hanif.
Thank you, Adam. Good afternoon, everyone. As we all know, libel will stop being published at the end of 2021, with a slight asterisk on US dollars, but we'll talk a bit more about that later. What I'd like to talk about this afternoon in the brief time that we have, if I could have the next slide, please. First of all, libel, once it goes, what will it be replaced by, and how different are these two types of rates? The second thing is, many contracts have fallback provisions. What are the issues with these fallback provisions as libel changes to the new rate? And finally, the relevance of these changes to variable rate loans, swaps, and even fixed rate loans, which often people think have no connection with libel, since libel is a variable rate. But nonetheless, there is a relevance, and we'll talk a bit about that. If I can have the next slide, please. So, what are the differences between libel and its replacement? Before we can really get into that, just a quick reminder on the way libel works. We call libel a forward-looking rate, and that's because at the beginning of any interest period, we know exactly how much interest will be paid at the end of it. We know that at the start of the period. So it's a forward-looking rate. I'll put a little example up there. Let's say we're at the 19th of August 2019, and 3-month LIBOR is 5%. And we borrow £10 million for 1 quarter. In this particular quarter, there's 92 days to the 19th of November 2019. So we know exactly how much interest we're due to pay on the 19th of November. And that number is just calculated there. It's a simple formula, and it's £126,027. If I could have the next slide, please. Now, the contrast with sterling libel's replacement, which is called Sonia, is that Sonia is a backward-looking rate. Now, what do we mean by that? First thing to know about Sonia and all the other so-called risk-free rates, which are replacing libel, is that it is an overnight rate. So it's only relevant for 1 day's borrowing. So if we go back to the same example as we spoke about earlier, on the 19th of August 2019, we don't borrow at libel, but we borrow at Sonia. Well, if Sonia is 5%, then we can only calculate the interest to the 20th of August 2019. The formula is the same, and on the 20th, we will owe £10,001,370. Now, this entire process has to be repeated from the 20th to the 21st. But we don't know what Sonia will be on the 20th until the 20th. So we will have a new rate, and it may not be 5%. It may be a different interest rate because it varies daily. And we will repeat this process all the way until the end of the interest period, the 20th of November. Therefore, it is only until we get to the end do we know how much interest we have to pay. Consequently, it's a backward-looking rate. I should say here that the other currencies that may be relevant to the audience, for example, the US dollar, dollar LIBOR will be replaced by something called SOFR, and ESTA for euros, and similarly for Swiss francs and Japanese yen, they have their own risk-free rates. They all share the same characteristic, that there are overnight rates. If I have the next slide, please. Now, there are a number of other differences between LIBOR and SONIA, and this chart seeks to illustrate those differences. The green line is SONIA, the dark blue line is 3-month LIBOR, and the light blue line is 6-month LIBOR. So the first thing to observe is that LIBOR, both 3-month and 6-month LIBORs, are higher, a bigger number than SONIA. The second thing to observe is that that difference isn't constant. The difference between LIBOR and SONIA is constantly varying. That's really a very important point, which we will come back to a little later. The third thing to notice is the difference between LIBOR and SONIA is different for different tenors of LIBOR. So 3-month LIBOR minus SONIA is different to 6-month LIBOR minus SONIA. And the final thing I'd like you to look at, which I won't dwell on, are these little spikes we see in the green line. Now, in sterling, they're relatively modest, but for US dollars, they're not. They're quite significant, and they are a cause of problems for the transition from US dollar LIBOR to SOFR. When you have a bit of time and you're back at your desks, perhaps look at the chart of SOFR in the last quarter of 2019, and you'll see a very substantial spike there. If we go to the next slide, please. So how will the replacement happen? Basically, it's not terribly complicated. Where you see LIBOR, you replace it with SONIA, but that would not be a fair exchange. Because SONIA is lower than LIBOR, we have to make up the difference to make sure that it's fair to both lender and borrower. So where before in a loan agreement you had LIBOR plus the loan margin, we'll now have SONIA plus the loan margin plus something that here I've called the extra spread, or the credit adjustment, whatever you wish to call it, which seeks to encapsulate the difference between LIBOR and SONIA. The tricky part, however, is the calculation of this extra spread, this credit adjustment. Because LIBOR and SONIA are different and vary over time, there is really only one credible way of working out what the difference is, and that is by looking at some sort of average over a period of time. The difficulty is this: what period of time should one choose? Because if you choose 3 years, it will give you a different answer to choosing 5 years or 10 years. Now, ISDA, the people who regulate the swaps market, documentation have suggested 5 years is the relevant period. There isn't an a priori financial logic that one can apply to come up with that period. It is arbitrary, and 5 years seems to be the period that's setting in the market. The other issue is how to calculate the average. Now, we're used to averages being the arithmetic mean. However, in this case, it's going to be the median. Again, the method of calculation will change the value. And for some methods, it'll be a high value, and other methods, it'll be a low value. So it'll favor one party or the other. And the final thing I'd say here is that this simple replacement of LIBOR with SONIA, or the risk-free rate, plus an extra spread, cannot be done for all agreements. There are a whole host of agreements. Bank of England estimates about 10% of all outstanding transactions cannot make this simple change. They've labeled them tough legacy contracts, and there's still an ongoing debate as to how to deal with these tough legacy contracts. I won't touch on tough legacy, apart from saying that tough legacy is not a very well-defined concept as yet. If I could have the next slide, please. So what of fallbacks? One of the clauses in the loan agreement is known as the historic screen rate. Now, what that says is, if LIBOR stops being published when you need it, then simply use the last one. So you can see that if LIBOR is never published from then on, we will use the same historic rate i.e. it turns a variable rate loan into a fixed rate loan. Clearly not what both parties intended when they entered into the transaction. A more troublesome one is the cost of funds fallback, which is surprisingly common. And what it says is, if I'm the lender and I'm lending you at LIBOR plus the loan margin, LIBOR disappears, we will replace that with my cost of funds plus the loan margin. My cost of funds for borrowing the money in the market with that amount and with that structure and with that tenor to on-lend it to the borrower. The difficulty is that the cost of funds is near impossible to calculate, and where it can be calculated often is substantially below LIBOR, so that the lender will lose revenue if the cost of funds clause is triggered. That will cause enormous problems for lenders, and consider those lenders whose credit rating isn't so high, in which case their cost of funds is much higher than LIBOR, and that cost will now be borne by the borrower. So cost of funds causes problems. Now, a quick word on fixed rate loans. Whilst the interest payment on a fixed rate loan is, of course, fixed and unrelated to LIBOR, the difficulty arises when the fixed rate loan is sought to be repaid. Often in these agreements, there is a cost to repayment. There's a break fee, a break cost, and that cost is calculated in relation to the LIBOR swap curve. But if the LIBOR swap curve no longer exists, how will those break costs be then calculated? So fixed rate loans should also be examined if you have them, if you've entered into them. What I've sought to do is to try and value these different fallbacks in pounds and pence. And there's a reference there at the bottom in the Journal of International Banking and Financial Law, which you can look at to try and put a figure on these fallback clauses. If you don't have access to the journal, let us know and we can send you a copy. So swaps. Now, you remember that in a swap agreement, one party pays the fixed rate and the other party pays the variable rate. So often, borrowers who borrow on a variable rate basis pay LIBOR on the loan to their lender and then enter into a swap where they're paying the fixed rate and receiving LIBOR, so the LIBORs cancel. Now, the issue is this. Since interest rates have fallen so much, the fixed rate that the borrowers entered into are much higher than the fixed rates that are prevalent in the market today, which means that if a lender wanted to cancel the swap agreement, there'd be a break cost to be paid to the counterparty, typically the lender. But if there is no LIBOR, then the borrower could argue that though they would want to continue with the swap, they're simply not capable of doing it because LIBOR doesn't exist. And this is termed frustration in law. And what that means is that they no longer need to pay on the swap agreement. And so they can get out of the swap without paying the break cost. Now, the whole law around frustration is complicated, and there are lawyers on the court who can best answer questions around it. But it is a real risk for those parties who are receiving the risk, the fixed rate, and a potential benefit for those parties who are paying the fixed rate. If I could have the next slide, please. So that's really what I've got time for, and I'll hand over back to Adam to continue the presentation.
Thank you, Hanif. That was very helpful in summarising the position with LIBOR. I'd like to hand over to Harry now to pick up his aspects of this webinar. Thank you.
Afternoon all, and thanks Adam and Hanif. As Hanif has hopefully given you a good base understanding of what is actually changing in respect of LIBOR, my part, I'm going to be covering three different things. We can have the next slide, please. Firstly, the cessation timelines and some key upcoming dates. Secondly, some practical tips on what we think every business should be doing in the near term to assess their exposure to the LIBOR switch. And then finally, into the legal aspect of actually documenting the upcoming changes. Next slide, please. Looking at the timeline then, there have been some significant milestones in the previous 3 years since the announcement of the termination of LIBOR. But from now onwards is when we actually see the effect of these changes in the mainstream. The reason I mention mainstream is because there have been some noteworthy transactions over the past year where non-LIBOR products have been implemented, most notably facilities to British American Tobacco, BAT, and Royal Dutch Shell. But of course, these are multi-billion-pound facilities that won't be hugely relatable to the typical mid-market size business. Looking forward then, by the end of Q2 next year, the target is that no new sterling LIBOR loans shall be offered. So theoretically, you shouldn't be offered any at the start of Q3 if you're coming up to an event such as a refinancing event or otherwise. Beyond that date, we have the final cutoff at the end of 2021. After that date, reference banks will no longer be obliged to publicize LIBOR. That isn't to say they won't be publicized, but the expectation is that they won't be unless crucial for the banks to do so for whatever reason. The logic being that these rates are based on so little transactional data that they just aren't representative, and it potentially opens up those banks to more risk than perhaps they are worth. The LIBOR scandal, of course, being the obvious case in point. The FCA's blessing would also be needed in order to publish those rates, which may not be forthcoming. So with that timeline in mind, if we could go to the next slide. It's clear that businesses need to be acting now, and we would encourage you as a first step to assess what financial exposure you have to LIBOR. But where do you look? Well, the obvious first port of call would be your facility agreements we have with banks or other financial institutions. Your interest rate will typically be an aggregate of a margin plus LIBOR. Less obvious places might be hedging contracts, which Hanif mentioned earlier. You should also consider other financial instruments such as bonds issued or investment held, and even less obvious might be exposures in commercial contracts or pension funds. So as you can see, the issue is pervasive and global. There'll be precious few businesses that are not affected by this change. If you want a good guide on how to start this assessment process, please do just get in touch after this webinar and we can let you have some useful material on that. So once you've established your financial exposure, you should consider the legal risks within your documentation. Do they cater for a change in LIBOR or the unavailability of LIBOR being published? If we take the example of a loan market association style facilities agreement, the language in the legacy contracts will rarely deal with a situation in a satisfactory way. Since the 2008 financial crisis, the market did start to build in language around the unavailability of screen rates for LIBOR, but they're very much designed as temporary measures as a result of market disruption, say. It didn't envisage a change in the reference rate. Therefore, our advice would be to tackle the issue by amending documentation in the next few months to provide you with more certainty. It's then at this stage, of course, that we'd suggest you develop a strategy for amending those material contracts to try and put you in as strong a position as possible. You should look at the costs in doing so. Does the contract, for example, stipulate who pays for those costs for changing the contracts? And indeed, should you approach your bank first or wait for them to approach you? We can go on to the next slide, please. So how are market participants dealing with these changes? Well, three main approaches are in practice at the moment in relation to loan agreements. The first is the future amendment approach. Here, parties rely on the ability to amend the pricing terms as needed at the relevant time. To facilitate this, the LMA have published revised replacement of screen rate clauses. This has been since added to the standard form of loan agreements. Until August 2020, this simply provided that on an event occurring, indicating that the actual or likely imminent discontinuation of the relevant interbank offer rate occurring, relevant amendments to the facility agreement should be made with majority lender consent rather than all lender consent. Since then, the LMA have recently published 2 separate notes suggesting drafting options to expand that scope to take into account the fact that the original drafting doesn't really go far enough to ensure the changes were made. The second approach is the hardwired switch approach. This is a mechanism to switch from LIBOR to an economically equivalent risk-free based rate at a specified future date before the end of 2021. I mentioned earlier those high-profile lending transactions. Those both contained hardwire switches. This does seem to be the most favored route currently. And the LMA have produced exposure drafts giving examples of how to achieve this. But crucially, these are still exposure drafts and have not been adopted by the market fully. Then finally, there's the hardwired fallback, which again is a mechanism to switch from LIBOR to an economically equivalent risk-free base rate if the event occurs connected to the discontinuation or unavailability of LIBOR. It's very similar to the hardwire switch, but without an automatic move away from LIBOR on a specified date. While this is standard in some markets, the approach is less commonly used in the UK. As Hanif mentioned, ultimately, the transition from LIBOR to a risk-free base rate should avoid any transfer of economic value between the parties. The total amount of interest, of course, then payable by a borrower should, to the extent possible, stay the same. If you want to discuss any of those amendment processes, please do get in touch after the webinar. We go to the next slide, please. Just before I end my part, I wanted to leave you with a few passing thoughts. So LIBOR for an interest period is of course fixed at the beginning of that interest period. All the parties know at the outset how much interest will be paid at the end of the interest period. By contrast, the total interest accruing over the period based on a compounded risk-free rate can't be determined until the end. So the look-back mechanism provides that interest payable over an interest period is not determined by the risk-free rate over the interest period itself, but by what's known as an observation period. That period is the same number of business days as the interest period, but starts and ends at a specified number of business days before the relevant interest period. That ensures that parties know the interest that will be payable at the end of the interest period a few days in advance. With that principle in mind, 2 calculation methods are being used. These are called the observation shift or the lag methods. The 2 methods are really similar in ways they're calculated, in that they use actual interest rates during the observation period. However, the lag method, you look at the number of business days in the actual interest period rather than the observation period when you weight the compounding rates. So why do you weight rates? Well, weighting of rates is due to the fact that there's no data available for the interest rate on a non-business day. So for example, if you come to a Friday, you multiply that rate by 3 to take you across the weekend. So you can see there are small differences that may occur where you have a different number of business days as between the observation period rather than the interest period itself. Economically, the difference in the results will probably be quite minimal, but practically that's less so. The observation shift method gained some traction earlier in the year in those major transactions, particularly I mentioned earlier. However, the recommendations currently are that the lag method be used on the basis that the observation shift could result in inappropriate calculations if loans are prepaid or traded mid-interest period. One of the downsides to the lag method, though, is that it can't take advantage of the risk-free rate indices that are currently being published. I've also mentioned there the cumulative and non-cumulative compounding calculation methods. Now, sadly, my first honours degree in mathematics from Cambridge is still in the post, but so I'll leave the explanation of how they're calculated to the likes of Hanif. But I will mention that until Q3 this year, cumulative compounding has been the preferred method of calculating interest on a risk-free rate-based loan. However, in September this year, the Sterling Working Group published recommendations for Sonia loan market conventions and some accompanying slides with that. And in those slides, they said, and I quote, "The non-cumulative rate method is a preferred rate for loans as it better supports intra-interest period events such as loan trading activity to distribute interest to the lenders on a pro rata basis." So if a lender transfers some or all of its loan commitments in the middle of an interest period, the amount of that interest that's accrued since the start of the interest period may determine how much one party must pay to another. Where cumulative compounding is used, that accrued interest cannot be calculated until the end of the relevant observation period. I've also mentioned there that legislative solutions. Now, there are some proposed legislative solutions for tough legacy contracts, which Hanif touched on earlier. They might be, for example, legacy Libor bonds, and that might be the most obvious tough legacy contracts. But my view is that I wouldn't try and wait for these legislative solutions to come in, and I would try and take a more proactive approach. And that's why, certainly on the last point there, I've said it's certainly worth stopping and thinking before you speak to your bank about any of the above to try and develop the appropriate strategy. So that's all I had on that. So I'll hand back to Adam.
Thank you very much, Harry, for that. And that concludes our two brief sessions on liable. We've now had a number of questions come through, as I mentioned, ahead of today and also from today's webinar. So I've just proposed to run through those questions that hopefully might be helpful to a number of our attendees. So the first question, I think, is one for you, Hanif. What is the expected value of spread adjustment for ED versus SOFR, SOFR, after fallback? Sorry, Hanif, you're on mute. Thank you.
Is that better? Yeah, that's a really good question. And actually, there have been a number of events in the United States. So, as everyone probably knows, that the targeted date for stopping LIBOR was the end of 2021. The take-up of SOFR in the United States has been particularly slow, and SOFR products haven't caught on. And I think as a result of that, as well as problems with SOFR itself, it being a very new rate, has meant that the United States authorities have said that they would prefer now to delay the demise of dollar LIBOR from the end of 2021 to mid-2023. That just came out a few days ago. All LIBORs, all dollar LIBORs, except for those with a tenor of 1 week and 2 months, they will still go at the end of 2021. Now, the reason why I mentioned that is because prior to that announcement, traders in the market had taken positions as to where they thought this credit spread adjustment will end up. Now, if I just walk you through that, the calculation is to be done at the end of 2021. We look back 5 years and we take the average of the difference between the risk-free rate, the compounded risk-free rate, and LIBOR. Now, we're only part way through that 5-year period, so we make some sort of reasonable guess as to what the difference will be for the remaining period. And that gives us an estimate of what that difference is likely to be when LIBOR finally shuts off. And with that number, one can then go away and trade and take positions in the euro-dollar market versus SOFR and in the basis swap market. The announcement last week meant that the calculation date has been now put back for dollars up until 2023. And all of those calculations therefore necessarily change. So there's been very active trading in the futures market and the basis swap market where traders are repositioning their risk in order to reflect their view as to where we'll end up. And what I'd say is that I would wait for a short while before the market settles down in order to be able to gauge whether it reflects where people on balance think we'll end up with the spread. So right now, I would say that it's a little early to judge. I think we have to wait for people to reposition their portfolios.
Okay. Thank you for that. Next question, possibly one for you, Harry, but Hanif do add in as well. How will the transition affect borrowers in the short term?
Yeah, that's a good question. I think inevitably there's going to be some disruption in the market, particularly as banks and borrowers are all going to try and scrabble to work out how these calculations are made and how they're communicated between each of them. So that's going to be an interesting period. But and the reason I say that is that we've particularly got, the reason we're doing this webinar now is to try and flag this as early as possible for corporates. We would suggest that you try and front load this as much as possible so that you aren't in the queue towards the end of next year, and you can try and sort out the processes early. We would also, given that the fact that there's going to be an element of disruption, it's probably worth considering how you deal with that in your documentation. There might be some additional negotiation points there, perhaps. So I'm thinking particularly on defaults around non-payment. There might be separate clauses around payment of interest, particularly if there is a dispute around how that's calculated. And then on the calculation point as well, you might see common in loan agreements that if a calculation is made by the agent or a bank, then that calculation is definitive unless there is a manifest error. Again, there's perhaps some negotiation room there. You also, in the short term, would have to just consider the amendment costs. Again, depending on which documents you're talking about and the extent of those, there might be an element of cost you need to budget in. I don't know if Hanif wants to add any more in there.
Yeah, just a couple of other things come to mind. The first is that the change in the basis of which you calculate interest from LIBOR to Sonia could also affect your covenants. Obviously, the interest cover covenant in particular. Remember that even though we're trying not to transfer value from one party to the other, Sonia and sterling LIBOR behave in different ways. So you just got to bear that in mind, particularly if you're close to your covenant. And the second thing is what are known as pre-cessation triggers, which we haven't mentioned yet. But if at any time the FCA believes that LIBOR is not representative of the market it seeks to describe, i.e. interbank, not uncollateralized interbank lending, then it can say so, in which case the calculation of that extra spread of that credit adjustment begins, or rather ends at that point in time. Now, a lot of people expect that will happen in the first quarter of 2021. So the calculation point may not be the end of 2021, but it could well be, perhaps even end of January 2021. So I think, as Harry says, really do it sooner, do your analysis sooner rather than later, because events are really already upon us.
Yeah, no, I think that's a cool message coming out loud and clear. It is to move quickly rather than leave it to a sort of last minute rush. Thank you both. Another question in, will banks and swap providers be aligned in their approach to long-term swap loans? Maybe one for Hanif?
Yeah, so what's happened with the conventions of how Sonia will be used is that for each question there have been a number of proposals as to how, for example, how many days lag do you need in the way that Harry described the way a Sonia loan might work. What is the averaging period and all the rest of it. With all of these things, there have been a number of consultations to ask the market what they believe is the correct way forward. And so far, really only ISDA has fixed things in stone, and they've gone for a 5-year period and various other conventions. Now, the other market, the Loan Market Association, futures markets, etc., in principle, could come up with different ways of doing the calculations. Now that will cause havoc in the market. And I think that's what the questioner is really referring to. So my view is that although everyone's going through various consultations, there'll be sufficient arm twisting to make sure that everyone alights on exactly the same solution. Now, otherwise, it'll make things very difficult and it will cause people with loans and swaps as hedges to have basis risks, which is really not the right thing to be doing. So my view is that they will all, in the end, align. And one of the issues is this: that what if I mentioned tough legacy contracts? What if the swap is not tough legacy because we can convert that in a straightforward way, but the underlying loan is structured and it is categorized as tough legacy? Well, that is also an undecided question. But the right thing to do, the common sense thing to do, is to put the two products together and say the two products together are tough legacy, and not to say that the loan is tough legacy and deal with it in one way, and the swap is not tough legacy and deal with it in an entirely different way, because the link then disappears. Again, an undecided question, but I think a common sense answer, but we just need to know what that answer is and we don't apply.
Yeah, okay, no, thank you. Another question that's come in. And it's a good one that springs to mind, is what happens if Libor is no longer available and the contract hasn't been amended? Possibly one for me to kick off with where my disputes hat. Certainly the starting position is to look at any fallback provisions within the contract. Are there any? Do they apply in the absence of Libor, which may help calculate methods of the interest that may be applicable? Failing which, is back to having those discussions with the bank to try and head that off before you run out of time. The sooner you start that discussion, the better, certainly from my perspective, in trying to reduce those risks. I don't know if Harry or Hannah, if you got anything else to add?
No, I think that's absolutely right. Before you enter into these discussions profitably, you've got to know what your position is in terms of your legal standing, what your contracts actually say, and how much they're worth, because these fallbacks do have value to them, negative or positive. So before you engage with your bank, know where you stand, and then engage with your counterparties as quickly as you can. Otherwise, disputes will result. I'm afraid I can't see what else can happen.
Okay, thank you. Some questions come in recently now. Probably one for Hanif. Is it realistic that parties could stop paying swap counterparties due to the removal of Libor, and what are the risks?
Yeah, so lawyers vary enormously in their opinion on frustration, just simply stopping payments. I think the consensus view is, and Harry, Adam, feel free to interrupt. My sense is, the consensus is that if it went to court, a judge is likely to say the frustration does not work. That's sort of been the history of frustration. And what they'll probably try and do is come up with some other mechanism that broadly keeps everyone in line. But whether that is the correct end game or not, we'll have to wait and see. But prior to that, it really depends on the documents that you've signed. So there are some ISDAs that have clauses in them that allow a process of determining or going through this sort of market disruption. But there are older ISDAs that do not. So the real answer to the question, and I suspect it's always this, is that it depends on the documents that you've signed as to how much risk that you're running. And a lot of the clauses that we wouldn't normally look at are suddenly now very important. So I think the key is to gather your documents and to read them or have them read.
Yeah, absolutely. The judges are reluctant to apply frustration if they can interpret the terms and conditions of any policies, from my perspective anyway. Okay, conscious of the time, so just run through a couple more questions. One for Harry, I believe. Whether there is a loan and interest rate swap with another counterparty, what happens whether there is a difference in calculation methodology with the lender from the swap counterparty? Would this be captured by tough legacy?
Thanks, Adam. Well, I think Hannah probably answered this question a bit earlier.
Yeah.
So I don't know whether it's worth going into again. The only other thing I'd just say is probably there isn't a one-size-fits-all answer to that. It's definitely worth looking at the contracts themselves and on a deal-by-deal basis. And we can certainly do that if the person who asked the question wanted us to look at it, we can.
Okay. Anything else, Hanif, at all to add?
No, not on that.
No. Okay. Well, that concludes our questions on this session. If you do have any more, please do contact us and we'll do our best to answer those. I wanted to say thank you again to Harry and Hanif for helping to explain what is a very complex area that's becoming live very quickly in 2021. I cannot stress enough, now is the time to start looking and reviewing your documentation from that perspective. The quicker business moves, hopefully the more likely it will have options rather than facing sort of a mad rush towards the end of this transitioning period. Once again, thank you to Harry and Hanif for your time. Thank you to everyone for attending this webinar. No doubt there'll be a few follow-up webinars in 2021 on this topic, as is a lot more to say on this. So thank you again.